Good morning and welcome to our technical webinar dedicated to the ELTIF, the European Long-Term Investment Fund, as introduced in 2015. This hybrid animal is actually a very interesting product because it allows institutional and retail investors to invest into such funds, which then are dedicated to long-term assets, which could also allow investments into real assets, private debt and private equity, the sectors we are representing and which we like a lot. Unfortunately, it has not really met its public and it was not really a success. So that's why there is a review upcoming, which we will analyze today. The goal is really to understand what could be changed in the future and how proactively that could be introduced in order then to make that, let's say, something very interesting, a good product also to help different people to access private equity also in the future. So the kind of democratization. So now we'll pass over to Silke Bernard, who is a partner at Linklaters, and she will be today's moderator. Just before we start, a quick reminder, your questions, as usual, are welcome. Please either use the chat or the Q&A function, and this webinar will be recorded and then also published soon on the different LPA communication channels. So without further ado, Silke, the floor is yours.
Good morning, ladies and gentlemen. Many thanks for joining this morning. I will be joined today for a discussion of the ELTIF review and the ELTIF framework and where we stand by Patricia Volhard from Debevoise Plimpton and from Jean-Christian Six from Overy. We will together try to share some insight with you on the ELTIF. Why didn't it start off like everybody hoped a few years back, and what is now changing? We will run you through the changes that have been tabled a few weeks back in the ELTIF review process, and we will show you what improvements are coming. There are a few points that could be further improved, so we are very hopeful they will still be improved, but all in all, it is a very good amendment that has been tabled, and we're very optimistic for the future of the ELTIF. So to set the scene, I think those who are joining today the session will probably be aware of what the ELTIF is, but just as a very quick refresher so that everybody has it right in mind, where do we stand, what is the ELTIF? Let's move to the next slide. So just as a reminder, the ELTIF, you probably all know, is an AIF, which is necessarily managed by an EU AIFM. It's investing in long-term assets. It has certain diversification requirements. And as you can see here in magenta, it benefits from a marketing passport, not only for professional investors, but also for retail. So that is the big distinguishing factor for ELTIFs, which is probably one of the most attractive points. If we move on, so far, that is really very simplistically what an ELTIF can do today. So the ELTIF has two investment buckets, the long-term so-called eligible investment assets, which need to be at least 70%, and they can have some liquid assets like these usage eligible assets you can see at the bottom, up to 30%. Within the eligible investment assets bucket, you have a defined catalog of asset classes or asset types. You can buy like qualifying portfolio undertakings, loans, real assets, to some very limited extent also target funds, like other ELTIFs, UVICAs and UCITS. You cannot so far invest in any other type of target fund, but we can come to that a little bit later. And there are certain restrictions, you see on the right, certain conditions. So it is a little bit restrictive, but still you can invest in quite a broad range of assets. We will see on the next slide what Stefan already briefly mentioned, so I won't go into detail of that. There are a number of strategies you could imagine under the ELTIF framework already now, and even more so in the future. So if we go on, you will see, or you may have seen, if you ever looked into the ELTIF, concretely speaking, that there were certain constraints, or they still are, but the ELTIF review will hopefully address some of these points. So there are restrictions, there are certain strategies you cannot run as of today under the ELTIF framework, and some of these points, actually quite a lot of these points, will be improved going forward. So we will talk about quite a number of them, and we'll tell you what is changing in the future. Let's move on just to get the picture as of today. We have 58 authorized ELTIFs today. They're not all yet on the ESMA register. Some of them are just ELTIFs I know that have been approved but are not yet on the website. You will see that out of these 58, there are 27 domiciled in Luxembourg, 16 in France, 13 in Italy, and 2 in Spain. What is interesting about these statistics is that you can see on the ESMA website that those ELTIFs that are most largely distributed across Europe are the Luxembourg ones. So you will see quite a range of marketing countries mentioned next to the Luxembourg ELTIFs, a little bit less so for some of these other countries. Luxembourg ELTIFs are also those that are most often sold to retail investors. And the number of ELTIFs is quite rapidly growing. So we have, I think, over the last 12 months, a duplication of numbers. So we doubled the number of ELTIF in Europe. It was a very slow start, and we will talk about that in a minute. So what is the time frame for the review? If we could move on to the next slide. The ELTIF has been initially adopted in December 2015. So the first ELTIFs have been set up in 2016. And since June last year, the EU Commission has very intensely consulted with the industry, with stakeholders on improving the ELTIF framework. It has been a very long and very good, actually, consultation process, because they were really in listening mode, and they wanted to understand why has the ELTIF not taken off? What is the problem? Are there any mismatches between reality of alternative funds and the ELTIF framework? Is there anything we could improve? So that was really helpful, and now we have seen the proposal. On 25th of November this year, the EU Commission tabled what they propose as the ELTIF review, and it is really an interesting framework. So we will run you through these changes and let you know also our personal insight and share some market experience with you to help you navigate these changes. So let's go to the next slide. I will not go into the detail, but one of the problems that has been identified is the demand side. So barriers on the investor side, how to get into an ELTIF. There are also supply side barriers. We will come to that afterwards, but it has been identified that it was pretty difficult to get investors into an ELTIF, both on the retail side and for other reasons on the professional side. So we will come to that later, but just that you know, this is the first bucket of issues the EU Commission has been trying to solve to facilitate access of investors into ELTIFs. Then moving to the next slide, which is pretty crowded. Apologies for that. I will not go into the detail of that, but this is just to let you know that it's not small tweaks that have been done. So the ELTIF review has been a pretty broad reconsideration of the ELTIF framework, and there have been many changes made, many improvements made. So you can look at these slides in more detail. I think they will be made available on the LPA website. But just that you know, the EU Commission has really looked at the detail and has really tried to improve the framework, and we will come to some of these points later. On the next slide, I have summarized some of the biggest issues that have been faced by the industry, and which many of which actually have been improved, like a clarification of certain definitions which were harmful because nobody really knew if their strategy was fitting in the ELTIF framework. Also certain structural changes that have been made, clarifications on investments in third countries, and so on. So quite a number of points that have been addressed. Same on the next slide. These are some of the changes that have been made on redemptions, on the authorization process of ELTIFs, which which shall be streamlined. So one can discuss if the wording that has been proposed is already the perfect one or can be further improved. An important point was also conflict of interests, where there was a provision in the current ELTIF regulation, which was well-intentioned, but in practice led to a number of questions and uncertainties, and had to be interpreted by the regulators or by the industry, by the actors, to make sure that it actually fits with reality of the market. Like the provision has, just to give you an example, has been interpreted by some as prohibiting the skin in the game investment of the manager. So of course that was a mismatch with the reality, and so this point is being clarified now. That is very, very positive news. Also some of these other structural changes you see here on the slide. Okay, so where do we stand in that ELTIF review process? The proposal has been tabled now in November. There is a hope that the new text might already be adopted in the first half of 2022, because there have been so extensive consultations and discussions beforehand. So we are very optimistic that the adoption might come very soon. Of course, there is a political agenda. There is quite a lot of other things on the table of the EU lawmakers. So a delay can never be excluded, but we are quite hopeful that the ELTIF review might be adopted still in the first half of 2022. Once adopted, there will be 6 months before it really enters into force. And so that means that during 2022, we could already be able to benefit from the new rules in the ELTIF 2.0 proposal. So let's move to our panel discussion. Jean-Christian, maybe start with a path. So what are the asset classes and the types of ELTIFs you have seen on the market so far? So which are the ones that have worked best?
Thank you, Silke, and good morning to you all. Well, as you said, Silke, in your introductory statement, well, for the time being, ELTIF may mainly invest into 4 classes of assets. So being, private equity and venture capital, provided the investments are made into qualifying portfolio undertakings, investments into loans, also issued to qualifying portfolio undertakings, and then we have real estate or assets and infrastructure, and then finally certain type of real assets like ships. And while those can be made either directly or via funds, but it's not, as you said, possible to implement a pure fund of fund structure under the current regime, ELTIF regime, as ELTIF may not invest more than 20% of their assets into other funds, and they may only invest into other funds that are either other ELTIFs or EU VECAs or EU CEFs. So personally, my exposure has been mainly to ELTIFs that invest into loans, so loans issued by qualifying portfolio undertakings, so basically loan origination funds. And this is one of, under the current regime, this is one of the most attractive features of the ELTIF regime, is that ELTIF may basically originate loans to borrowers based in other EU member states. And so the ELTIF regime is a very convenient way. Of course, it comes with a number of constraints, which are significant, as you explained, Silke, but the ELTIF regime may be used for instance, Luxembourg funds structured as ELTIFs in order to originate loans, so grant loans to borrowers based in a number of EU member states, which have significant restrictions in terms of banking monopoly, and do not allow or only subject to very restrictive constraints foreign funds to loan to borrowers based in their jurisdiction. So the typical example is France, but so the only way for the time being for a Luxembourg fund to loan directly or to grant loans directly to French borrowers is via this ELTIF passport. But you can also use the ELTIF in order to lend to borrowers based in other EU member states, like Italy, but also in Norway, which is not part of the EU but the EEA, and Portugal as well. So for the time being, I believe, based on the current regime, the main reasons for using an ELTIF, well, is either because you want to do cross-border lending into those restricted jurisdictions, and in that case, you can use the ELTIF regime, irrespective of whether the fund is well, reserved to investment by professional investors or open to retail investors as well. So that's one main attractive features of the ELTIF. And the other case is in case where you have a fund manager willing to raise capital from retail investors and benefit from the ELTIF retail passport. So my personal exposure was mainly to ELTIF in the loan origination space.
Perfect, thanks, Jean-Christian. Patricia, have you also been active in the loan space, or which other asset classes have you seen being used most in the ELTIF framework so far?
Yeah, well, obviously for the reasons you set out in the beginning, Silke, I haven't seen many, to be honest, and I believe we all haven't seen many. And so I think from my perspective, I agree with Jean-Christian. The asset class for which I think ELTIFs are currently the most attractive are debt funds, because of the possibility to have loan origination, which is not possible, and which sort of solve the banking monopoly issues that we have in some European countries. That said, I mean, we will discuss further, I believe that advantage might go away with the revision of AFMD2, which now will also then, or currently at least, provides for loan origination also for ordinary AIFs. So we will have to see how that develops. Otherwise, I think ELTIFs, where I see them being used or clients being interested in this type of fund structure, is mainly to make use of the marketing passport to a retail investor base. Usually not retail, sophisticated investors still, but sophisticated investors that wouldn't meet the professional investor definition.
Thanks, Patricia, and I will come to what you were alluding to in a second. So on my side, if I'm allowed as a moderator to add, I think what I've seen is the first ELTIFs being in relatively liquid assets like PE or private debt, indeed. And now I'm seeing, I think maybe also because the market has seen that it can work, I see more illiquid strategies coming up, like real estate, renewables, infrastructure, and so on. So I've seen indeed quite a range, but with that clear move from the more liquid strategies with short-term, like 2 to 5 years maturity, and now it's really the very long assets that are being held over a very long period. But Patricia, you said something just a second ago that was for the reasons you mentioned. So what is your personal interpretation on the reasons why the ELTIF did not really fly, or had at least a pretty slow uptake since 2016? What is your interpretation, and what are the main pitfalls which have held it back?
I think the main pitfalls are, I think the most attractive sort of reason for an ELTIF is the possibility to market to a retail investor base, or more sophisticated but not professional investor base. And in particular, if you look in the private equity space, for those types of investors, the type of product you would offer is a very diversified product, you know, in the form of fund of funds. And I think the lack of fund of fund solutions that can be, you know, realized by ELTIFs is or has been a real issue, or has been a real obstacle to using ELTIFs in practice. So that's one reason. But along with that, I think also other reasons are that the rules, the investment restrictions are too prescriptive. There are too many. The possibility to make investments also outside the EU, but also you know, using borrowing. It's generally, I think, the regime has been too restrictive. And that, I think, has been addressed, as you said, and we will talk about that in the new draft. But for now, that was a real problem. I think, lack of fund-of-fund solutions and very prescriptive and restrictive regime in terms of investment possibilities, opportunities.
Thanks, Patricia. Jean-Christian, anything you wish to add on the reasons for the slow uptake?
Not really. So I think Patricia covered the main reasons. It's simply because the regime is too prescriptive. So I know that a lot of fund managers have looked to it and said, okay, it's not worth it, at least not for the time being, but I believe that they will revisit the position with the new proposal, which has been tabled with the EU Commission a few weeks ago.
Let's look into the new proposal. Jacques-Christian, what is the initial feedback or the reaction you're getting from your clients? Is there appetite? Do they welcome the proposed changes? What is the initial feedback you're getting?
Well, the initial feedback from my clients is extremely positive, and some of them are very excited about this. And first of all, I think there is really a momentum around ELTIF for the time being, because as you said, there are only 57 ELTIFs across the EU for the time being, which is, of course, not a lot. But actually, the number of ELTIFs in the EU has more than doubled over the last 12 months. So it's clearly market is picking up with the ELTIF, and I believe the EC proposal, which will significantly increase the attractiveness of the ELTIF regime, will certainly trigger a significant uptake in the number of ELTIFs that will be launched. And I believe this is a unique opportunity for Luxembourg, while being the by far the largest domicile for ELTIF for the time being. I think the proposal from the EU Commission is very timely. Because retailization of alternative investment funds is really becoming a hot topic for the time being. I believe the FM directive has done a very good work in terms of harmonizing the EU market, alternative markets, and while introducing a kind of level playing field along EU member states. But unfortunately, the AFMD marketing passport is limited to professional investors. And it's very complicated for the time being to implement an alternative investment fund and distribute it while really putting together a kind of a distribution strategy allowing for the raising of capital to non-professional investors, so to retail investors across the EU. Many private banks are putting a lot of efforts into that, and they would typically either give exposure to their private clients via discretionary portfolio management mandates, or sometimes they're trying to use funds in order to raise capital from non-professional investors. But either they have to go for they really need to have a kind of country-by-country strategy, because the rules governing distribution of AIFs to retail investors, is not harmonized at EU level, and therefore you need to look at local rules. And this can be a very painful process. And the truth is that in many cases, you will simply need to have different vehicles, or at least different solutions on the country-by-country basis. So, to answer your question, Silke, yes, the feedback, at least from my clients, is extremely positive, and some of my clients, are determined, and I'm speaking about some of the largest asset managers globally, are working on projects, ELTIF projects, and they really want to fully exploit all the benefits of the new ELTIF regime as soon as the new regime will become available.
The same you are hearing? I hear your clients previously were quite reluctant to actually jumping into the ELTIF framework and doing it. So is it now a bit more positive?
Yes, definitely. I think the proposal was very well received by the industry. I think, for an industry that is making long-term investments like private equity and infrastructure, the ELTIF could be a really interesting fund structure. And with the new changes, that is clearly going in the right direction. So I think that the feedback was consistently positive.
Yes, I fully agree. But indeed, I've seen some of even the US sponsors, some of the top US sponsors are looking into ELTIFs and trying to unlock that potential of private money sitting on savings account. So I think we all are very positive and very hopeful for the new framework. But Patricia said there are a few points that can be further improved. I just see a comment that the ESMA register only says 57. Yes, I took the liberty to include those that we have received recent approvals on and which are not yet on the ELTIF register. So thanks, David. Patricia, you said earlier one of the really interesting features could be fund of fund ELTIFs. So there is a proposal on the table. What is your comment on that? Do you think that's great, or what is your wish list to further improve?
No, I think the proposal is definitely going in the right direction. So it's permitting investments now in funds, in European funds, other ELTIFs, UVECAs, UCITS, and so on, and other AIFs managed by EU A funds. So that's positive. What I think could be improved, or is a bit unfortunate, is that for the retail investor base, which again, I think from a sort of PE perspective wouldn't be retail, it's still quite sophisticated investors. And for those, the investment in funds has been restricted to 40% of the funds, which obviously doesn't really work for a fund-of-fund investment strategy. So I realize co-investments are permitted, so you could have 40% in funds and then the rest in other assets, including co-investments, but it doesn't really suit a fund-of-funds investment strategy, which again, I think is particularly attractive to a retail investor base because it offers diversification. I think the other sort of improvement that if I could wish for, would be to have also non-EU funds being included. I think also, again, from a risk diversification perspective, it would make a lot of sense to permit an ELTIF also investments in non-European funds, at least those that, for example, have been approved for marketing in the European Union, and fulfill certain requirements under AFMD, under the national private placement regimes. I think, there are various things that can be thought of, but permitting generally a global investment strategy and investments in non-EU funds, that would be something very well received and welcomed.
Yeah, I fully agree. And I think when we had a meeting with the EU Commission, I think it was in January or February this year, they were actually open to that idea to allow even non-EU target fund investments. It finally did not find its way to the proposal. I'm not sure whether it's totally excluded, as you were saying, Patricia. There are still discussions being held, so maybe certain points are still being improved or further softened or further flexibilized. So we can hope, and I think there are a number of discussions going on right now with IFAMA, AFI, LBA, other industry bodies to try and move things even a little bit further on the flexible and interesting side of things.
Yeah, there's one thing, sorry to interrupt, Silke, there's actually one important aspect that I think could also be improved, and that is the requirement to invest 60% of your assets in eligible assets within 5 years. I think that doesn't really match the fund of funds investment pace. I think that should be something more along the 10 years in order to really reflect a fund of funds investment scheme. So that's another one that I would have on my wish list if I had the choice.
Yeah, that's right, because so far the ramp-up period has been structured for direct investments. It has not been conceived or designed for fund-of-fund strategy. So that is a very valid point. Jean-Christian, would you subscribe to Patricia's wish list in terms of fund-of-funds, or do you have additional wishes? We are just before Christmas, so maybe somebody listens to our wishes.
I think clearly the fact that, well, ELTIFs are now allowed to invest into EU AIFs managed by an EU AIFM. And by the way, they don't say that the EU AIFM needs to be an authorized AIFM. So I suspect that means that, well, registered AIFM or funds managed by registered AIFMs might be available as well. But okay, they just remain silent on this point. So I think that the fact that, well, ELTIFs are now allowed to invest into AIFs which are not ELTIFs, EU CEFs or EU VECA is clearly a step in the right direction. But I know that many of my clients are very disappointed that for ELTIF retails or retail ELTIFs, the ability to invest into funds, well, is limited to 40% of the capital. And by the way, the term capital is defined under the ELTIF regulation is a bit annoying because they're taking, well, the undrawn commitments are part of the capital. So it's also something that fund managers need to get used to it. So as Patricia said, it will be possible to, well, to a certain extent, get around that restriction by using co-investments alongside funds. But of course, well, co-investment is not the same as, well, direct investment into funds. And so clearly that's mainly a solution, I believe, which would be appropriate for large asset managers that have a range of other funds which they can use and maybe having the ELTIF while co-investing alongside one or more of their platforms, well, maybe by investing at the level of underlying SPVs. But of course, this requires a bit of engineering, well, I'm not really sure to understand what's the policy reason that's behind that restriction. So I think it's an issue. And also maybe one final point to note is that for the ELTIF retail, which will be subject to risk diversification requirements. So in case of investments into funds, so they will have to look through the relevant target funds and to basically aggregate the exposure to the underlying assets of the target funds with their own direct investments in order to apply the risk diversification requirement. So that will require also a bit of engineering at that level, because when investing into target funds, ELTIFs will have to make sure that they have proper flow of information from the target funds so that their administrative agent or depository can apply the risk diversification on a look-through basis. And maybe one final point is that it will be possible to structure a pure fund-of-fund ELTIF, provided the ELTIF is reserved to professional investors. But it's not entirely clear to me in which circumstances a fund manager would want to structure a fund-of-fund that is reserved to investment by professional investors in the form of an ELTIF. So that's.
No, I agree, because the fund-of-fund feature was a very nice one, because it's one that is typically used for retail investors or the mass affluent kind of retail investors. So that would be a very nice fit, because these investors are used to it, they feel comfortable with it. We do have safeguards. So indeed, it would have been a very nice feature. And I think there's a lot of appetite in the market to have fund-of-fund ELTIFs, but 40%, that indeed, I would agree with the two of you, 40% is not a fund-of-fund. So 40% is a kind of mix in, but if you still need to have 60% directs, it's not really a fund-of-fund. But pursuing that idea a little bit further, Jean-Christian, I often hear from my clients the question, well, can't we have a feeder ELTIF into one of our flagship master funds? Is it something that will come and that will be possible?
Well, unfortunately, no. And it's true that this would be a very attractive. And by the way, this is possible under the EU VECA regime. So under the EU VECA regime, it's possible to have an EU VECA while feeding into a master that is not another EU VECA. So the EC, well, the proposal of the European Commission introduces a master feeder regime, but both the feeder, okay, but the master fund must be another ELTIF. So which of course reduces the attractiveness of the master feeder structure under the ELTIF framework. So that there are very detailed rules in the ELTIF regulation or the proposal of the EU Commission on master feeder structures. But okay, considering the limited interest of those master feeder structures because of the restriction I just mentioned, I don't believe it's worth going into those details today.
Fully agreed. There was another specific asset class we discussed when we prepared for this session. We were discussing if an ELTIF can be used to invest or to finance fintechs. Patricia, do you have a view on that? Is that possible, or what are the constraints?
Yeah, well, unfortunately, that's also one that would go on my wish list. So unfortunately, right now, ELTIFs couldn't invest in financial institutions, and I think that does not take into account. I mean, generally, I think I would agree that understand at least the background of that restriction not to invest in banks and real financial institutions. That said, we are in a business in the venture capital and private equity where we do see a lot of fintech startups coming up, very interesting investment opportunities, and a very popular target for venture funds with a venture capital strategy. And that's exactly what I think the legislator would like to support. So I think it would be good to amend the rules to permit investments in these financial undertakings or financial fintech companies. One way that you could maybe to solve the sort of concern that it is not wished that ELTIFs invest in real classical financial institutions could be to limit the investment in fintechs, so in companies that qualify as small and medium-sized enterprises, and at the same time have an objective to support the delivery and use and improve the delivery and use of financial services. I think that's something that would be hugely welcomed by the industry and would be a huge improvement.
Thanks a lot. So we have mentioned a few times now already that difference in strategies and in assets between professional investors and retail investors. So the called mainstream ELTIFs and the carve-outs for professionals. What are your personal views on that? Does it make sense? Jean-Christian, maybe starting with you, because you mentioned it in your very early comments on what ELTIFs you are seeing currently on the market and the French specific loan origination thing. Do you think it's a good idea to carve out certain rules for professional only ELTIFs, or do you think it's not necessary? What are your views?
I think it certainly makes sense to allow ELTIF, which are reserved to investment by professional investors, to make investment with less restrictive rules. And while under the EC proposal, so while professional ELTIFs would not be subject to any risk diversification requirements anymore, which, by the way, I believe probably means that in Luxembourg we're maybe being a bit too restrictive in terms of risk diversification for CIFs and Rave, but that's another topic. So I think it certainly makes sense to allow to give more flexibility to professional to non-retail ELTIFs, but still there is a question that remains, I believe, relevant, is in which circumstances under the new regime, the ELTIF regime, would it make sense to use an ELTIF, well, if you do not target retail investors? And well, for the time being, I believe that one of the main attractive points of the ELTIF is the fact that it allows you to do cross-border lending into certain jurisdictions like France. But well, as I believe you or Patricia said earlier on, there are wordings in the AIFMD review, according to which under the new AIFMD regime, it will be made clear that while EU AIFs managed by an EU AIFM may do cross-border lending across the EU. So maybe this may, basically waive this, I would say, a competitive advantage of ELTIF over normal EU AIFs. But of course, while the AIFMD regime, the AIFMD review is not there yet, so we still have a couple of years to wait for that. And also, I note that this reference to cross-border lending by EU AIFs, well, it's not included in the operative provisions, or at least not based on the proposal from the EU Commission. It's only a recital, so it remains to be seen how certain countries, and I'm thinking of France on the French side, for instance, will look into this and whether they will really change their, I would say, internal regime in order to allow EU AIFs, well, based in other EU member states, to lend to French borrowers. But then there are also a number of, I would say, mismatch between the AIFMD review and the ELTIF review when it comes to funds investing into loans, and the interplay between the AIFMD regime, or the to be adopted, well, AIFMD regime and the ELTIF regime are not entirely clear to me. For instance, you know that under the FMD review, it's proposed that AIFs that basically originate loans for more than 60% of their portfolio should be close-ended. So we don't have that in the ELTIF regime, which allows, subject to certain conditions, ELTIF to grant redemption rights to their investors. So does it mean that, if the AIFMD review and the ELTIF review are adopted in their current form, the only way to do an EU loan origination fund while offering redemption to investors would be to go via an ELTIF? Well, I don't know. And also I know that in the ELTIF review, we don't have the risk retention requirement that is proposed to be introduced in the AIFMD regime for AIFs that basically originate loans and then sold them off on the secondary market right away. So, but I don't know if this is intentional and whether it's really the case that what is not permitted in the AIFMD regime will be permitted if you're using an ELTIF. Frankly, from a policy standpoint, I'm not sure that would make a lot of sense, considering ELTIFs may be marketed to retail investors. But okay, I'm not sure that logic is always a good guide into, when you're reading or interpreting those provisions. So maybe there are more political reasons behind those.
That would be pretty positive for ELTIFs, right? If the regime was more flexible here than on the AIFMD. Patricia, what is your view on these professional carve-outs? And maybe if I may add a second related question, do you see a risk that the ELTIF label or stamp could be diluted with all these flexibilities being added, and especially if you have a professional ELTIFs with very low diversification requirements and very low standards being imposed? Is there a risk of dilution?
I don't know is the answer. I think, first of all, very interesting remarks, Jean-Christophe, to compare this AIF regime under the AIFMD and loan origination and the ELTIF. And I could see how maybe that was done on purpose, that you think you're being more restrictive under AIFMD in a certain sense and permit more under ELTIF, where you have also a more restrictive regime in terms of what you can invest in, what we just discussed. And so maybe from that perspective, one was thinking that you can, in fact, have certain redemption rights here while investing 100% in loans, which you couldn't do under the AIFMD regime. But, that's something to be seen. And I certainly think these are very interesting comments. I think generally, I agree that the ELTIF is mainly a retail product. It's nice that it's being opened up or certain restrictions, and I think it's good that certain restrictions are being waived for a professional investor, funds, ELTIFs that have only professional investors. But then what would be the benefit to choose an ELTIF if it's no longer loan origination as such? Well, it could, for example, be, but that's still, to be seen, if in other regulatory frameworks, the legislator introduced certain advantages for professional investors investing in ELTIFs, like under Solvency II, for example. That's something I could imagine, would obviously be then an incentive to structure a fund as an ELTIF for a purely professional investor base.
I agree. I see we have many questions in our chat, so just to leave some time to answer these questions. There was one last point we were to discuss, but which I will just briefly mention, and maybe we should rather concentrate on the questions then instead of going into the depths of MiFID. But just for everybody to have heard it once, there are also changes to the framework under which retail investors can enter into an ELTIF. So previously we had a number of specific requirements like a special suitability test, special thresholds, and so on. So all that is being aligned, or it is proposed to align that with MiFID to streamline the process and make sure that distributors don't have like a double or triple test to make when they have investors into retail ELTIFs. But that was just to mention it because we have a number of questions. So let me go into the chat function and just address these one by one. And thanks for all who have submitted questions. So the first question we had was retail ELTIFs. Do they have to be Part 2 funds, or could they also be something like a Rave or an unregulated SCSP? So what are the structures we would commonly see being used for ELTIFs? I don't know who would wish to answer that.
So, well, in Luxembourg, so if you are really targeting retail, and I mean pure retail investors, well, the only option is the Part 2 fund. But because, well, if you're choosing a product like a SIF or a Rave, which is subject to Luxembourg law, well, investors' eligibility requirements, and if you're launching an ELTIF, you will need to comply with the most restrictive provisions of both regulations. So the fact that you have a SIF or a Rave, which is subject to the ELTIF regime, doesn't mean that you can sort of bypass or avoid the investors' eligibility restrictions applicable to SIFs and Raves. So if you are structuring an ELTIF as a SIF or a Rave, or a CCAR, by the way, so you can only market it to well-informed investors. But of course, we know that the concept of well-informed investors is broader than the concept of professional investors under MiFID and under the FM directive. So some of the well-informed investors that, well, you would target with a SIF ELTIF or Rave ELTIF, well, would be considered as retail investors for the purpose of the EU regulation.
I think the Part 2 regime is a pretty natural one for an ELTIF because there you can really target potentially all retail investors. I think the CSF also feels quite comfortable with that because in their mind it's very natural ELTIF being a retail fund that one would use a Part 2 fund. What I've seen a few times though is, for instance, if you wanted to start your fundraising very quickly and you had a professional like anchor investor, you might have started with a Rave and then do the upgrade to later Latin retail investors at a later stage. So the mass affluent or high net worth retail investors, if you didn't want to go to the very, like the men in the streets, the very small retail investors. So I've seen that a few times. In theory, under pure legislation, also an unregulated SCS or SCSP could be used. There's no prohibition. It might be that the CSSF feels a little bit less naturally comfortable with it, but I've seen, I think, by now all kinds of structures being used. So it does work. Sometimes you have indeed, as you said, Jean-Christian, sometimes you have the questions from distributors. Okay, how do I juggle like the ELTIF selling restrictions like the thresholds and the suitability test and the Rave rules and the MiFID rules? So that combination of the three, how does it work together? So in practice, I think the Part 2 fund is a very natural and easy way forward if you want to go to retail investors. Okay, then we have another question, which is a very interesting one. So that is about Evergreen. So one of the points we as Luxembourg have lobbied for, and many others have as well, but which has not been proposed, at least not strictly speaking, is Evergreen ELTIFs. So an ELTIF without a defined term. That has been seen as being really interesting to the industry to avoid like having to launch a successor ELTIF every 10 years or so. That would be really interesting. Patricia or Jean-Christian, do you have a view on that? If there are any workarounds, will it still be softened? Do you believe it will be softened throughout the legislative process? What are your views?
I do think that would be interesting to have a possibility, in particular because we're talking about when we're talking about long-term strategies like infrastructure, very long-term strategies. I think that could be a very interesting structure or module. How would you deal with it in practice now, given that it is not possible under the current regime? I think I understand that, at least in Luxembourg, it would be permitted to have very, very, very long-term funds going up to, I don't know, more than 50 years. Please correct me if I get this wrong, but that certainly, you know, could address in part the concern. And you can obviously always build in the redemption rights through side pockets and gates. So I think, you know, you can find ways to structure an evergreen fund while ensuring, you know, redemption rights in a sort of solid way. So yeah, it would be a very welcome improvement from my perspective.
Well, I believe that it's really an oddity that you cannot have an evergreen ELTIF, well, considering the long-term nature of the product. And well, even if you can have an ELTIF with a term of 50 years or 100 years, well, then who cares, really? I think that that's good enough. But I think there is what the EU Commission or the EU authority seems to work on the assumption that, well, the only way to give liquidity to investors is either through redemptions or by providing a specific term for the fund, so that investors have a guarantee that after, well, I don't know how many years, well, the fund will be liquidated, that they will get their investment back. But actually, there are other ways to offer liquidity to investors. It's, well, through a listing. And even if we don't see a lot of those products, well, in continental Europe for the time being, well, we have to look at the UK market. And in the UK, you have a very large universe of what they call investment trusts, which are basically closed-ended funds which are listed on the London Stock Exchange and invest, well, across, well, all asset classes, alternative asset classes. And, well, these are funds which really offer liquidity through the secondary markets, because there is a deep secondary market on the London Stock Exchange. And I believe that, well, with Brexit, etc., there is a huge opportunity for the EU to try to kind of develop similar products, well, in continental Europe. So we can still have an EU fund or ELTIF, well, being listed in the London Stock Exchange, but why not in the medium term or long term have the ambition to have a stock exchange in the EU for those closed-ended funds which can offer a similar level of liquidity as the London Stock Exchange. But so I think it's an oddity that we don't have the ability to launch, well, evergreen ELTIFs, well, under the current regime or the new regime, well, unless this were to be fixed in the context of the legislative process. But, well, because of the ability to launch, to establish an ELTIF with a very long duration, I believe that in practice the implications will be very limited, and, well, promoters will have the flexibility they need to launch similar products.
And I think you're right, Jean-Christophe. I think it's sort of the assumption to think that alternative assets or illiquid assets is something that you can really only liquidate at the end of the term, or, you know, by selling. It's sort of nowadays you do have a very active secondary markets for private equity and also infrastructure portfolios, if we're, for example, talking about fund-of-fund concepts. So I do think that you could actually reflect, again, always with certain gating mechanisms, of course, but you could reflect the necessary liquidity to satisfy redemption rights also on a long-term basis.
Yeah, no, I would share your views. We already, indeed, as you said, Patricia, we already have in Luxembourg 50, 60, 70-year-long ELTIFs that have been approved. And although I had many clients asking for evergreen ELTIFs, at the end of the day, when they heard that you could have like 70 years or 99 years or whatever you want ELTIFs with liquidity windows, I think most of them said, okay, that's fair enough. That works for us as well. It's not ideal, but we can make this work. Just to share a little bit of insight, which I think I can share, when we had discussions with Brussels stakeholders, we were given indications that actually it's not very likely that we will move to a real evergreen structure, like with unlimited duration, because in certain member states that would trigger certain requalifications, because it would then be truly unlimited. So we were told, look, there were some strong feelings amongst some of the member states, and so it is not extremely likely that true evergreen will come. But I think, as Jean-Christian and Patricia said, in reality, it may not be the biggest issue as long as we can have very long ELTIFs. There's a last question, and then I'm prompted to conclude, and Stefan is waiting to say a closing remark. So there's a question on the ELTIF tax treatment. I know some of the member states have created specific tax regimes for ELTIFs. In Luxembourg, we had tried in 2015, and at the time, for other political reasons, which were not really related to the ELTIF, that has not been implemented. I have received some indications that maybe it's worth giving it another try. So I think we will do so. We will give it another try to come up with a specific ELTIF tax treatment. Of course, that is member state by member state. At some point, there was also a proposal being put on the table across Europe to find a special withholding tax regime for ELTIFs and for ELTIF assets to make it truly attractive to also invest cross-border. I haven't heard about that for a while, for a few years, to be honest. So maybe that will also be reactivated. It would be really nice to have an attractive tax regime to get away with any tax obstacles or leakages. So I think point taken here. Thanks for the prompt. I think we will look into that again and try to come up with an attractive tax regime for ELTIFs as well. So we had other questions. We had other questions we planned to discuss, but the topic is so vast and so hot that probably we won't make it to the end. I think Stefan is waiting, but just Patricia or Jean-Christian, would you wish to say one last word to the audience for them to take home with before Stefan is doing his closing remarks?
Okay, happy to start. Well, in my view, maybe not one word, but one sentence. I believe that there is a huge potential for Luxembourg. And I believe that, well, even if the ELTIF in its initial format has not been a success, I believe that there is real potential for the ELTIF 2.0, and Luxembourg is uniquely placed to seize the benefit of that new pan-European regime.
Yeah, I fully agree with that. I think Luxembourg is, they have gathered experience already with ELTIF, so that's great. But with these new sort of proposals, I think there's a lot of potential, and I think if there are some further tweaks to be done, in particular in the fund of funds section, I think that could be a huge success. Yeah. So
we are moving to a glorious future. Stefan, I will hand back to you. But first of all, thank you very much, Patricia and Jean-Christian, for your insight. And back to you, Stefan.
Thanks a lot, Silke, for the great moderation, and also to you, Patricia and Jean-Christian, for sharing your insights, experiences. It looks very promising. We like that. And we also are huge fans of corrective, constructive regulation, meaning when it doesn't work, then let's see what we could change. So that's really a good step in the right direction. As you were able to hear today, I mean, it's certainly a vast topic. So why not organize next year a kind of follow-up one on different new elements, or depending on the discussions, but that would be a great one. So again, thanks to you, dear panelists, and also the audience for joining us today. And we wanted to wish you certainly some very safe and nice Christmas holidays, and wanted to say goodbye and see you in 2022.